Aha, you're back. Well done. Stay exactly where you are, because we've done a Mr. Ben routine, gone through the revolving door, changed our team of fund managers, and we're back in the room to talk all things income related. We've had the wider market overview, and you've heard some good debate and some friendly differences of opinion around what's happening out there in that global marketplace. But now we want to specifically get stuck into the search for yield, the search for income in today's marketplace. And in order to do that, who else would you want in the room than Toby Vaughan from Santander? We've got Laura Frost from M&G, and of course we've got Guy Davis from Saracen. Folks, we've heard a little bit about the wider market dynamics this morning and the wider investment landscape. Advisors out there are going to have an increasing number of clients who are looking for that sustainable income yield at a time when it seems as though the status quo of modern portfolio theory is up in the air. Where should they be looking? What are the things that are happening inside the war rooms in your offices when you're charting out where all the noughts are going? Toby, start us off.
It's a good question. I think the first point to make really is that when assets are cheap, income investing is relatively easy, and the job is fairly easy, and we're in that situation now where no asset class is really cheap. So number one, you have to be realistic in what your income targets are. Number two, you have to work a little bit harder. So from our perspective, as we move down this route where yields are lower in fixed income, and the same is the case in equities, etc., we have a realistic target at the overall level, because if you don't have a realistic target, you can be taking inappropriate risk that the clients are not wanting. So we target a minimum 4% yield in our portfolio. We're actually only running a strategy at the moment that's targeting 4.2%. So we're keeping it controlled, so we're not dragged into asset classes we don't want at this stage of the cycle. We take quite a diversified approach to how we generate income at the moment. We've got around just under 60% of our yield is generated from our equity holdings, right, and around 40% from our fixed income holdings. So it's quite a diversified strategy. I think the other theme we're looking for at the moment is when we're accessing equity markets through funds, for guys like this, we're looking for things that are slightly less traditional, different ways of accessing income within equity, different ways of accessing income within fixed income, and that goes to sometimes a slightly less traditional approach and different subcomponents of each of those universes. So very high level, and I'm sure we can probably get into fund specifics and the kind of things that we're looking at, but realistic income targets, a diversified approach to enhancing your income and looking for different things from the portfolio just to also generate different forms of return and manage risk in a slightly different way. But if you're talking about modern portfolio theory, do we think the role of bonds is over? My answer to that would be no.
Right, okay, I'm going to come back to some of those specifics for you in a minute then. Laura, it's a shame we couldn't bring Paul Flood back in from the previous session, who, from a multi-asset point of view, effectively said that he wouldn't go near fixed interest at the moment to save his life. As the investment director in retail fixed interest at M&G, I take it you agree with him?
Well, I was actually standing outside the room thinking, where is Paul? He shot past me fairly quickly. Right. From our perspective, I think the important thing at the moment when you are in fixed income is to remain flexible. Yep. You obviously have mandates which are more restrictive and more vanilla and perhaps used as building blocks, yep, for some of the portfolios, whether they are European, whether they are sterling focused. But in a range of funds, we hope at M&G to have something for all weathers, and there are a number of obviously flexible mandates. From an income perspective, obviously, income is a natural derivative of fixed interest. It's about picking up the pockets where we do see value, because obviously some bonds are very expensive. We've seen spread compression throughout high yield, throughout investment grade, and obviously we know what's happening in the government space. So it's about harnessing the areas of value and making sure that we do that in a controlled fashion, whereby essentially delivering a nice steady income stream, yeah, for the clients.
Okay. Guy, tell us what's the house view in Saracen. I'll also reference the fact that you guys run the Verbatim 5 Income Fund as well. what's that search for that steady yield looking like?
I think one of the most important things to think about, and certainly the way we, Saracen as a house, approach investing across the board, but particularly for income as well, is that we take a completely global approach. If you look at the UK market historically, there's a big focus on UK equity income. It dwarfs that in terms of global. It's about 63 billion AUM in UK equity income money within the UK, about 17 billion in global. So it's a much bigger marketplace here. One of the things we think about is we're thematic investors, so we don't invest necessarily on geographical sector lines. We invest across the world based on long-term kind of inexorable trends, if you will.
Okay.
One of the reasons we do that, certainly, I think with income at the moment, it's important to ensure that you're not just hitting a high yield today, but you need to hit sustainable income, and ideally income growth. And that's one of the areas that's a real concern. And I think one of the reasons investors today should be really looking at a global approach. If you take the UK income market as a whole, take the FTSE 100, you get 40% of all of your income from just 5 companies. Yep. So there's a massive amount of concentration risk within that marketplace. What that means is if you're trying to generate a really high yield from that market, you're almost forced into a very small list of companies, and you end up carrying a lot of stock-specific risk. If you move to a more global basis, you have a much deeper pond to fish in. You also arguably have a more sustainable pond to fish in. The UK is definitely a high-yielding market, about a 4% headline yield. But the dividend cover at an index level is below 1. So at an index level, some of these dividends are being paid from debt, which is not a long-term sustainable model. If you look at a broad-based global index, you can see dividend cover in excess of 2. So you've got more sustainable income moving forward. So for us, a key thing really, I think, it's been a focus for Saracen, ever since its inception, but I think particularly today, being global in the way you approach income, I think, is absolutely essential.
Okay. Bear in mind, folks, I do want your questions flooding in for this session. I need a deluge, please, or there'll be questions to answer for you. Guy, tell us about some of these themes. Then you're looking globally, but you mentioned specific themes that you want to then put across the globe. What are those themes based on this sustainable demand that you see?
So we have a long list of themes, but I'd say the key thing to think about is we're thinking about, I mentioned kind of inexorable trends. We're looking for the sort of things that won't necessarily be disrupted by what Trump does with his tax plan, or won't necessarily be disrupted by Brexit. We're looking for the sort of things that will persist in a variety of macro and political environments. A good example would be the explosion we've seen in data consumption, both fixed and mobile. Okay. In the last 10 years, exponential growth in the amount of data that people are consuming, mobile phones as well as computers. That's a sort of trend that will continue for the next decade or so, and it's almost impossible to see a way in which that will be disrupted. More and more of us are using the cloud. I'm sure that's connected to the cloud right now. More companies are using the cloud. You also have a big increase in video consumption online. Video is hugely data intensive, so people are streaming video online, people are watching Netflix, Amazon Prime, people are doing so at home, they're also doing so on the bus, on the train. Couple that with smartphone penetration. You still have arguably reasonably high smartphone penetration within large parts of the developed world, UK and US in particular. Huge areas in emerging world, it's still very low. And mobile networks are getting better, enabling people to use these smartphones more and more. So as a result, that gives rise to a huge amount of opportunity over the next 10 years. And it's really hard to see how that gets disrupted. So then that provides opportunities for us on a stock and a fixed income level. We can think about the mobile phone operators themselves. We can think about the companies that build and operate the mobile phone masts. We can think about fixed line providers. We can think about data center providers. So it gives us a kind of a wide array of investment opportunities where we can be confident that the underlying profit growth should be reasonably consistent over a long period.
Okay, it starts to tell a nice story. How do you balance that with finding the right story and the right underlying assets in that fixed interest world?
So interesting, you mentioned some of those sectors, and I was sat here nodding. Absolutely agree with you. There's a number of telco companies obviously out there. You mentioned the masts, the getting from A to B, etc. I think that whole sector is of interest to us. It has been for a long while, particularly in the US. They've got steeper curves where there's more credits available, and obviously the better those companies become. You mentioned that the derailment of that industry is probably unlikely to happen, regardless of what Trump does, etc. So, from an ability to pay back their debt, then that's definitely an area that we like as well, and that's one of the pockets really of credit that's attractive at the moment, and we see that income stream being quite stable moving forward.
Okay.
So.
Toby, talk me through then one of these very different assets that you're looking to pull together in order to look beyond the usual, and talk me through. We bought this, but here's then the logic that led to that decision.
Okay, so I mean, well, fixed income's probably a good point to start on this, and ultimately, so we've been constructed on US global high yield for some time, and that's a trade we've had for 1 to 2 years. But we moved to this environment now where we're actually thinking the genuine absolute return potential on this asset class is really looking less compelling relative to more defensive assets. Maybe it's there, but so that's a starting theme. Actually, we're becoming a little bit more cautious on high yield. Now we manage portfolios within volatility ranges, so we've got explicit volatility ranges we have to manage with them. So we have to take risk. But we are less convinced about one of our asset classes where we're really comfortable before. So what do we do? So if we're trying to manage to our volatility, distribution technology level 4, we need to be taking risks so we don't go outside of our volatility bands, which is paramount importance to us. So the case is, if we don't like that asset class, where's it going to go? Does it go to equities? Well, as I said before, we've got about 60% of our income coming from equities. We do like equities from the longer term growth potential. But in the shorter term, for a number of different reasons, we're not looking to increase our equity risk. So what do we do with that? We're looking to enhance returns on the portfolio in fixed income still, but to do it in different ways. So what can we invest into in a daily liquid environment that isn't taking excessive credit risk, duration risk, etc.? And it's one of those situations where all these other asset classes, there's always a counter argument whether it's the right thing to do. But so we've looked at things like emerging market debt, and in fact we actually just bought a position into emerging market debt. But that's not overly different. So we've also just invested into a preferred securities fund as well, which is slightly different, so that's kind of in between, on the capital structure in between equity holders and debt holders. So we've moved from a strategy, excuse me, in our high yield bucket of the portfolio of being completely US and global focused. And over the past 3 to 4 months, we've brought in a preferred securities fund because it behaves differently. It is lower yield, it's around a 4.2% yield, so it's not quite as much as high yield. But that 4.2% is aligned with our current target at the overall fund level. But it's different. It's driven by different factors. I'm sure there would be volatility and a risk off, but it's still different, driven by different factors. We also brought in emerging market debt recently as well, because it's driven by different factors. Yes, okay, it's going to be sensitive to the US yield curve. Yes, it could be sensitive to a tightening of financial conditions globally or movement in the dollar. But I'm just saying this, preferred securities, EMD, they are a function of a deteriorating view in the traditional asset class, needing to make sure that we manage within our volatility bands, and this desire to bring in different ways of getting return in a daily liquid UCITS framework that behave differently and bring something different to the portfolio. And it really is that. And I don't want to just be the person who talks about managing risk, having different things, because we also take risk in certain asset classes. We're still quite constructive. But we're looking to slightly re-engineer pockets of the portfolio and to try and be more creative, for want of a better word.
Okay. How would you do that then? What's that re-engineering and creativity look like?
Well, as I said, it's we brought in the preferred security. So we are looking to improve the risk-return characteristics of each individual part of the portfolio.
Right.
So on the fixed income, we're looking at the combination of these different kind of strategies: preferred securities, emerging market debt, short duration funds with high yield, to try and get a better risk-return framework and a lower correlation with other parts of the portfolio.
The entire market seems to be offering in and around 4% income at the moment. Is there anything out there? Is it feasible and realistic to look for any higher income yield than that from a multi-asset portfolio?
I mean, I can start with that because we run a number of portfolios, 3% targets, 4% targets, 4.2%. The one thing I can tell you, a 3% target portfolio looks radically different to a 4% target portfolio, and that looks radically different to a 5% portfolio. So, that level, it is important. The one thing I would say is, there are vehicles there that can give you more. You've got the maximizer and the booster funds and etc. that everyone uses, and they can be 6 or 7%. You can go into more risky emerging market debt that can be 5.5%, 6, 7%, etc. But ultimately, as soon as you start going well above that 4% target, you are taking quite a significant amount of risk. Be that drawdown risk or complexity risk for some of these strategies as well. So my point really is it looks very different. 4% is the kind of right level-ish if you want to achieve growth and given the yields across asset classes. But I would say if anyone does come up with a much higher rate, especially on the multi-asset side, always beware about how much risk they are taking, especially if they just decide to have no bonds in the portfolio because they don't like it. I think that's a risky strategy in the multi-asset context. The role of bonds is changing in the portfolio. I think it's about removal, not reduction. They're more of a diversifier and a manager of volatility and drawdown. Ultimately, it might be less effective in the future, but to completely dismiss bonds in a multi-asset context is a dangerous thing to do.
I've got an interesting question here from an advisor, Nick Westcott. He actually says it's a question for Guy, but I'm going to make it to everybody because I think he's been a bit mean just offering it to you. And he says, I live in southwest of England where the demographic is quite elderly. Would you have any advice of a good way to invest my relatively small income, please? I think that we can paraphrase that as, and going back to my 4% issue, is that really the optimum income yield to manage risk effectively for the average consumer out there?
To be honest, I mean, from my point of view, I think the 4% kind of as a target is a pretty high target as we stand today. And I think if you're hitting a 4% target, particularly from an equity level, you are certainly taking an element of income risk and you're also taking an element of capital risk. If you're hitting a 4%, let's say, portfolio yield, you will have stocks in there that certainly yield less. You'll have stocks in there that yield more. In the environment we're in where with fixed income and rates where they are, if you've got a stock yielding 5 or 6%, realistically, it's going to have some hairs on it. There is going to be something going on within that company. So I think the 4 is reasonably hard to hit. One of the things I mentioned earlier, I think is really important, is not just yield today, but it's sustainability of yield. You may be seeing a 4% yield today, but if you're looking at a company whose payout ratio is at 1 or above 1 and they're paying out of debt, it's not a sustainable environment to be in. It's much nicer, I think, to have, let's say, a slightly lower yield, call it a 3 perhaps, but where you can have confidence that that yield might be growing. At least those companies would then have flexibility to not just pay the yield, but also have some cash to invest for the future as well. And effectively, we have to think that dividend growth over the longer term, it is simply a function of earnings growth. You cannot have dividend growth without earnings growth. So we've got to remember as well that we're looking for companies who are going to be growing their earnings over the longer term. And I think the danger with income investing is that you target too much of a high yield and you sacrifice that growth element moving forwards. And I think that can be a real risk.
Okay, Laura, how would you use the tools available at your disposal in the fixed income sector to answer Nick's question around I guess it's that sleep at night feeling?
Yes, absolutely. And I think bonds and fixed income gives you the ability to sleep at night. So from his perspective, it's about flexibility, it's about staying global, it's about sourcing the pockets of income in credit or value in credit that you believe are sustainable, as we mentioned. For us, what's really important with yields where they are at the moment, I mean, in the last 2 weeks, the entire UK curve has shifted out, 15, 20 basis points or so, and that's across the board. Now, we know that from an interest rate sensitivity perspective, that's damaging. So in terms of flexibility, staying fully flexible, making sure that you have a mandate, which is, as you say, can do something a little bit different. And if that's pulling back the interest rate sensitivity, the duration, to very low levels, expecting potentially yield curve steepening or, in fact, parallel shift where the whole curve moves up, if this sort of this bullish nature and this hawkish nature of the Bank of England continues, then fixed income has its place. It will allow Nick to sleep at night. It will deliver the income. Our job is to preserve the capital because the income is derived from the capital. And that's the beauty of bonds over, potentially a slightly more volatile asset class such as equities.
How would you answer Nick's conundrum?
Well, we embrace the beauty of all asset classes in what we do. I think to answer his specific question, I think it really does depend on his time horizon and his threshold for loss. And I don't want to get in the territory of advice process at all. However, just to give context, so we're targeting 4.2% yield. What does that require? That's we've got around that 40% allocation to equities and some higher income paying equities. We've probably got 15 to 20% of the portfolio, just about a year of duration, coming from risky fixed income assets, be that high yield, EMD, etc. So that is a risky portfolio. So this is a 4.2% portfolio is one that is I don't want to use the word aggressive, but it's being managed for growth. It's looking to deliver return over the long term. So if he's got a short-term time horizon, I think a 4% probably is too high. We've got 3% portfolios as well on the multi-asset side that is much more conducive to a slightly lower risk profile client. So for me, I think it's a good question, and often when income funds are sold or talked about 4%, 3%, they're not talking about the return and the volatility expectations. Well, it's risk, return, and time horizon. I always think in those three things. So ultimately, if he's got a long-term time horizon, 4% fine. If it's a short to medium term, he's probably looking for a lower target yield, which is naturally going to have more of an allocation to some of these fixed income assets that we've talked about.
Okay. In the previous session where we were having a tour of the world from a macro perspective, we looked at there was a consensus that emerging markets was where some of the managers were looking at from a growth point of view, and a perception that there is essentially a discounted sale on at the moment in that marketplace. What's your views in terms of that part, in terms of the emerging markets as a source of income generation, though, rather than particularly long-term capital growth?
I think arguably it's potentially a source for both over the longer term, income generation as well as capital growth. I mean, you certainly, some of the panelists before mentioned some of the really long-term trends that you have in emerging markets, which will likely provide the opportunity for great growth over the longer term. If you look at the emerging market index, there is a huge amount of very high yield on offer in emerging markets, but of course one has to be careful that some of that carries more risk than you would see in developed markets. So we have a big focus at Saracen on stewardship and ensuring that there's appropriate governance controls within the companies that we invest in. And certainly that's one area that I think it can be quite difficult to get over that hurdle when you're looking at some of these emerging market companies. As shareholders, we want to be confident that the management and control will be sensible with how they allocate their capital, not just in terms of what they do with, let's say, mergers and acquisitions, but also what they do in terms of shareholder returns, dividends and buybacks. We want to see appropriate capital allocation, and we want to be, ensure that as shareholders, they are running the company for us, for our benefit, as the owners of the business. And so those governance concerns can be an issue for some emerging markets. And I think as a result, you just need to be very selective in terms of the companies that you go for within emerging markets generally.
Is that true for when you're looking at it from the debt perspective out there?
Yeah, I would agree, absolutely. Emerging markets is very much a case by case, and whether that's on a corporate level or whether that's on a sovereign level, there are governments out there that are better and safer and, let's just say, more transparent than others. It's very much about experience. It's very much about understanding how that country works and how it sort of it manages its own current account deficit, etc. So, in terms of EMD, I mean, you only have to look at so hard currency government done 9% year to date. I mean, fantastic returns, but you have to be able to stomach the volatility. So we've all seen what happened in Venezuela. You could pick up credits there for, 30s. But it's, that's not something to base a portfolio on. I think from an EMD perspective, whether it's corporate or whether it's sovereign, it's about diversification. It's about making sure that you are in a number of these different countries and you really are spreading your risk. Because as we say, the search for income has forced clients further, out along the risk spectrum compared to 10 or even 5 years ago. Would my mother be investing in emerging market debt now? Probably yes. Was she 10 years ago? Probably no. So the search for income is important, but it's up to us as fund managers to manage that diversification and therefore manage that risk profile.
And what provisions do you guys have in place when you're looking at the market, particularly interest rate rise potential, and how that may or may not play out in terms of the strategies you're putting in place? What's the house view on these are the things we need to consider should the central bank start putting those interest rates up at a pace?
Yeah, well, I think when you talk about interest rate risk on a portfolio, number one, you've got to have a strategy and you've got to control and you've got to be aware of how much interest rate risk, just on the bond side, regardless about the indirect effects that it might have on the equity side. As I said before, our duration is around 3.8 years on our portfolio. And we're looking to make sure that we've got exposure not just into interest rate duration, but credit duration, different credit duration, etc. But then again, we have to be worried about a steepening of the credit curve as well. So that's, it's not just a steepening of the interest rate curve. One thing that we have to be very mindful of now, especially as people are taking more credit risk to get their income targets, is a steepening of the credit curve, which is ultimately going to be driven by a risk-off event. So number one, it's being in control, being aware of it, and at the moment, our view is that central bankers are being fairly pragmatic, probably happy still at the margin to be behind the curve and wait for some of these kind of inflationary pressures to develop. But we've got to be very mindful that inflation doesn't get out of control. Everyone's talking about this deflationary environment we're in. Everyone's talking about secular stagnation, aging populations, etc., technology, no inflation risk, etc. But when, in the US, for example, we're closer towards that 4%. Historically, this can be that, in terms of unemployment, that can be that level where you start to see inflation risk. Happened in the 60s. Now, so that is where inflation suddenly went from 1.7 to double that within a year. So if inflation gets out of control, we think we're going to have a problem on the equity side as well. So at the moment, in terms of interest rate duration policy, it's kind of managing it in the fixed income part of the portfolio, diversifying that. On the equity side, whilst inflation is under control and banks are pragmatic, we're relaxed at the moment and we still see growth potential on equities. But it's very key that central bankers stay in control of potential inflation risk, which is why we actually think the bond market is too bearish at the moment. And actually these movements we've had in sovereign bond yields in the last few weeks completely make sense to us.
Absolutely. We don't have a house view. We run 19 fixed income funds. The managers are in charge of their own sort of destiny, their own portfolio. Yeah. So you have sort of a rainbow of very, very bearish on credit and then very, very bullish on credit. Some of the more bearish managers have other levers to pull, other than just credit. Maybe they have currency. Some of the more restrictive mandates have to look maybe off benchmark. So areas like securitized products, a lot of them are UK focused anyway. They are generally short maturity, so it plays nicely into some of those short duration plays and a protection against obviously rate rises. But couldn't agree more with the credit spreads at the moment. They are fairly low. I think we always make a comparison versus 2008 when they obviously blew out. If you actually look back further than that, we've still got some way to go before they hit the levels of 2003, 2007. So actually, if you had, just carried on chipping away at coupons throughout 2003, 2007, you would have made a decent total return. So, I think we've got used to direction credit compression. If it doesn't continue, it doesn't necessarily mean there'll be a spike. It might just be a continuation, and let's harness that total return.
Totally disagree with them. Go on.
No, the only point I would make, certainly from the equity side, is that I think certainly high income equities will be sensitive to interest rates to a certain extent, but I think they'll be sensible on a multiples basis. It's not going to affect the underlying earnings of these companies. So if you're still investing for companies that you think will grow their earnings over longer term and grow their dividends, you have an element of protection. It will be the kind of the hardcore bond proxy equities that really get hit. And I think that's where you get into danger with the really high yielders. If you get above kind of 5-6% yield, that's going to be the area that really gets hit. So as long as you're building in reasonable growth over the longer term, I think there's an element of protection there. It's also worth just bearing in mind as well that if you look back, numerous academic studies will show over a very long period of time, 20 years plus, the vast majority of your returns over a long period come from income. You know, even if you go over a 5-year period, more than 50% of your returns come from either income growth or just straight income yield. So it's very much a strategy that will perform. There will certainly be periods in which it might be out of favour, and that may well be the case if we see aggressive interest rate rises. But over the longer term, it's a very sustainable strategy for a huge amount of people because it's such a big chunk of your overall return as an investor.
Excellent. Well, time has caught up with us. Thank you very much indeed. You guys stay right where you are. In a minute, I'm going to interview Chris Fleming from Distribution Technology, all about some changes that they're thinking of making to their strategic asset allocation. So we'll work out whether or not he knows what he's talking about. And then we'll be back with Ken Davey about the general advice marketplace and some defined benefit pension transfer conversation later on. You stay there. See you in a couple of minutes.